or max to max 5 years. So let's look at the one by one aspect of business planning. So the first thing that comes when we talk about business planning is definitely, nobody would disagree with me, is budgeting. So budgeting, okay, let's understand budgeting. I mean, from a national government to big corporations to a small household industry, hardly there is any entity who has not done a budgeting. But let's understand what budgeting is. In terms of understanding, anything which we plan more than for 1 year is called budgeting. Okay, anything which is more than for 1 year is called as budgeting. Planning is definitely which is under 1 year, but the fundamental difference between planning and budgeting is a budget is always expressed in financial terms. For small organizations, the budgeting may be just expressed in a single budget, but in the big organization, budget can be expressed in number of links budget, such as sales budget, operation budget, revenue budget, and so forth. The most important point in budget is that it's all the action that needs to be translated into financial number, which sets a target for the organization to meet. And then after budgeting, we would like to have some idea about planning. People generally confuse planning with budgeting, but now I think with that example it would be easy to distinguish between what exactly is budgeting and what exactly planning is. Planning is nothing but a simply set of action to achieve a certain target in the future. It can also be expressed in financial terms. However, many people like to associate planning with financial number to make it more meaningful and measurable. So a simple example of planning is if an FMCG company plans to achieve a sales target of $10 million next year, it's a plan. And planning can be also done in sales and revenue, second capital and expenditure, third headcount and staffing, and fourth definitely expenses. So here is an aspect of looking into the scenario which we have looked into is integrated planning and consolidation. After that, the big question comes of consolidation. Apart from integrated planning and consolidation, the second point is consolidation. So consolidation plays a major role in the corporations, in fact in the bigger corporations. So here the topic is definitely so here in integrated planning and consolidation, well, let's understand what's consolidation would mean to us. Okay, so finance, in terms of finance, and in terms of finance, Consolidation is fundamentally purchase on acquisition. So in simple terms, okay, buying a majority, okay, there we go. Okay, buying a majority of stake of the target company, and exercise control over that company is simply mean as consolidation. Okay, let me give more material about this. A control company may continue to operate and maintain its own legal existence, but it has to be under the new ownership. So and after that, see, the fundamental purpose of consolidation is to have it's regarding this about the legal existence. Control company may continue to operate and maintain its own legal existence, but as I have told earlier, in the new ownership, and the important purpose of having consolidation with regards to BPC is to prepare consolidated statements. Say example, let's take an example to understand it better. Say example, P&G as a company bought 100% of the stock of Unilever. Now Unilever is a subsidiary of P&G. P stands for definitely, as parents have quoted in P&G. Even though Unilever is a separate legal entity, it would be viewed by an accountant as a part of larger economic entity. So here consolidation is fundamentally for preparing consolidated statement. Okay, so let's move to the next area, why BPC has carried such an importance in different business scenarios. Okay, it also enables intercompany matching and reconciliation. Okay, let's understand in very simple language what does that mean. Okay, so reconciliation, okay, between two branches of the same company located in multiple locations. Okay, it means two entities would have a different books of accounts, right? So whenever a transaction is done between them, it is treated later at the end of the year. It is treated as reconciled, and the right of each other's account in their respective books. Let's take an example. Whereas one branch acts as a seller and the other acts as a buyer, and product has moved from branch A to branch B. When the branch A sends some product to branch B, then in this case branch A becomes a seller and the branch B becomes a purchaser. But what happens at the end of the year when the financial reports are prepared? It doesn't mean that A have to actually give physical money or check or transfer money to B, because they are fundamentally one legal entity. But these needs to help to keep an account from where the book is coming, from where the material is coming, and into our own entity from the goods are going. So that is very well taken care by BPC. That is the reason why we need BPC. Then also the next point is very relevant in today's scenario, that is called as intercompany elimination. Now we have seen on the above examples intercompany matching, where books are are kept into each where the books of records are kept into each other's record. Now understanding intercompany is just a process of removing that transaction between the companies. And the first thing is just to note it down that okay, these are the things which is happening between two companies. But when these intercompany matching is done, it also needs to be eliminated at the end of the year, because if you do not do that, it would show a false picture of the books and the statements. Because it is also important to eliminate entries that are made of removing the effects of the intercompany transaction. And there can be many types of so to note it down, what in a simple sentence, to note it down, what intercompany elimination means is the process of removal of transaction between two companies. That would be enough for this understanding at this moment. So we have in intercompany elimination we have three types of elimination. First is called as stock ownership, elimination of stock ownership, which means it eliminates the assets as well as the stakeholders' equity account for the ownership in simple language, it eliminates the assets as well as the stockholders' equity account for the ownership of subsidiaries and parents. Let's take an example where an asset was there in the same entity where asset was there, and say example a machinery. So one machinery has been transferred to another entity. So in that and machinery is definitely is an asset where it has been transferred from one entity to another entity. So it's just for the namesake it is given as stock ownership. Stock doesn't mean the physical stock. I'm talking about the equity stock. Yeah, that definitely means as not the physical inventory. It doesn't mean the inventory. It means the stock of the company, in the sense the stock market, the equity thing. Okay. Then second is debt elimination. What does that mean? Okay. In this elimination, an entry is performed when the parent company makes a loan to the subsidiary. This is respect to the liabilities. First thing we have seen with respect to assets, and now this is with regards to liabilities. So even intercompany elimination is done into the scenario where one company owes a debt to another company. Then the last but not the least is elimination of revenue and expenses. Elimination of revenue and expenses. Okay. Why this elimination of revenue and expenses is so important with regards to implementation of an BPC project? So what does that mean? It means when a company, when goods or when revenue generation, it can be sales, or it can be interest has been paid or been given to another company on behalf of their parent, of their main entity. This also needs to be eliminated. So sales to be associated companies, interest expenses or revenue on loans to or from associate companies. So it means whenever sales is an expense for one entity, and it's in what do we say, it's in revenue generation for the